In the second half of Chapter 11, we're going to explore how to analyze the risk in the cash flow estimation we developed in Part A. We're going to look at 3 ways to analyze risk: sensitivity analysis, scenario analysis, and simulation. And to close out Chapter 11, we'll look at the application of real options in capital budgeting, a subject we touched on in Chapter 8. In our chart, we've seen repeatedly, Chapter 11 focuses on estimating and analyzing project cash flows. In a capital budgeting context, risk refers to uncertainty about the future profitability of a project. There are several ways to measure project risk. Historical data is exactly that, history. In judging the risk of projections, we usually have to depend on subjective judgment. In general, there are 3 types of risk. Standalone, the project is the only investment of the firm. Corporate risk, how the project fits into the product line of the firm. And market risk, how does the project affect the firm's investors? Standalone risk is by far the easiest to estimate, but it ignores firm and shareholder issues. We can use the standard deviation or the coefficient of variation of NPV, IRR, or MIRR as a metric. As you'll recall from Chapter 6, the flatter the distribution, the riskier the project. The second type of risk is corporate risk, how the project fits in the firm. Corporate risk considers the firm's other assets. Are there diversification benefits from pursuing this investment? As an example, the blue dashed line is the firm without the project. The red line is the project, which looks pretty risky, but look at its effect on the overall firm, the green dashed line. As with a stock portfolio, adding investments that are not perfectly correlated with the rest of the firm reduces the firm's overall risk. Market risk, while considered the most important, is the hardest to evaluate. It takes into account investors' other assets. Market risk is, by general definition, the most relevant type of risk, but it's also, as I said, the hardest to measure. Corporate risk is a bit easier to quantify, but not much. It is, however, highly relevant to so-called stakeholders, those who have a relationship with the firm. While market risk and corporate risk are important, standalone is the easiest to measure. Additionally, most firms' projects are highly correlated with the firm's other assets. In the past, firms have been driven to diversify, acquiring various firms outside their core business. For most, they found they weren't very good at running businesses they weren't familiar with, and have since divested themselves. A few, such as General Electric, have been successful at managing very diversified operations as part of the whole. The first technique we'll look at is sensitivity analysis. We want to find out what the impact is of changing one variable, leaving all others fixed. We choose the variables to work with based on which one's estimates we are most concerned about, or which we think will have the greatest impact. For our example, we chose unit cost, unit sold, and salvage value. We're letting each variable change plus or minus 15 and 30% to gauge how sensitive NPV is to changes in each of these, and the resulting NPVs are shown in the table. Using the data from the previous table, we can graph our results. Notice how steep the line is for units sold, and that it's upward sloping. This implies that as units sold increases, NPV increases. Makes sense. The upward slope means the relationship between units sold and NPV is direct. They move up and down together. The cost per unit line is downward sloping, meaning the relationship is indirect or inverse. Cost per unit goes up, NPV goes down. Finally, the salvage value line is almost flat, meaning changes in salvage value will have very little impact on NPV. Recall that in order to draw a straight line, you only need 2 points, 2 coordinates. We have one, the base case, so all we need is one other point. We only need to compute one new NPV, and we have all the data we need. Shown on the slide is the sensitivity ratio, another formula that's not in the book. It will tell us everything the graph does. Using the minus 30% data from the table, we can compute the sensitivity ratio for our 3 variables. Note, on the graph, the cost per unit line was the steepest and downward sloping. This is reflected in the negative sensitivity ratio, which is the largest of the 3. The unit sales sensitivity ratio is positive, indicating an upward sloping line and a direct relationship. It's very close in absolute size to the cost per unit sensitivity ratio, so these two are the most important variables. The salvage value sensitivity ratio is the smallest and positive. The variable having the most impact on NPV is the one with the largest absolute value of the sensitivity ratio. Because cost per unit has the largest sensitivity ratio, reflected in the steepest line, it's the variable we should focus on. We need to make sure our estimates of cost are as good as possible. We don't need to worry as much about salvage value since it has so little impact. Sensitivity analysis measures standalone risk, so it does not reflect diversification, nor does it address the relationship among variables or the likelihood of a variable changing. The most important role for sensitivity analysis is to identify dangerous variables, where we should focus our time. Scenario analysis uses the best case, worst case we've all heard about. Our most likely case is our base case. In this example, we've identified the best and worst cases and their probabilities, which allows us to apply basic statistical techniques to find the expected NPV, its standard deviation, and the coefficient of variation. Scenario analysis, like sensitivity analysis, only measures standalone risk. Also, it assumes all the worst choices occur together and all the best together. Basically, you get the tail end of a distribution, all the worst and all the best. Simulation analysis is a computerized scenario analysis. The computer selects values for each defined variable from a probability distribution and reruns the analysis many times. The process is repeated thousands of times, with NPVs and IRRs calculated for each repetition. The output is generally shown graphically. A major problem with using simulation analysis is defining the probability distributions for each targeted variable, along with their correlation with each other variable. Most corporate managers don't have the statistical background to do this without some serious in-house support. The following slide provides a small example of a simulation analysis. Suppose we're only going to analyze unit sales and selling price. We've defined the probability distribution as normal with the given means and standard deviations. The process selects a variable from each distribution randomly, runs the analysis, and calculates NPV. Here are the results of 2,000 trials. The results are shown graphically on a coming slide. Inputs are consistent with specified distributions. Here are the results shown graphically. Notice that the upside potential appears to outweigh the downside risk on this project. Simulation analysis has the advantage that it does reflect the probability distributions of the input variables. The major downside, as we've already noted, is the difficulty in specifying the distributions and correlations. All three of the risk analysis techniques we've looked at suffer from some of the same disadvantages. None provide a decision rule. Like ratios, they point you to areas that need attention. All ignore diversification since all measure standalone risk. If we look at the coefficients of variation from the scenarios and the simulation, we see that both are well above the average for the firm, indicating a high-risk project. While we have measured standalone risk, this usually indicates high corporate and market risk as well. If we consider this a high-risk project, then one way to adjust for risk would be to increase the discount rate from 10% to 13%. The project remains acceptable as the NPV is still well above zero. Note that you can see this for yourself by changing the cost of capital in the Chapter 11 case Excel file to 13%. We spent a lot of time on quantitative analysis, but the truth is, numbers may not capture everything about a project. This applies to both negative as well as positive factors about a project. On the downside, the potential for lawsuits should be considered. Just because a project has a positive NPV doesn't ensure that it's a good project. Numbers can be manipulated. You should be able to articulate why it is a good investment. Does the firm have a strategic advantage in the market? Are there barriers to entry for competitors? We discussed these briefly back in Chapter 8. Realize that NPV is a static analysis technique, meaning if the project is accepted, The assumption is that it will be started, run, and closed down exactly as described in the analysis. This isn't real life. As a project unfolds, changes are made based on market conditions. Some types of options include timing options. Should we invest now and be the first to market, or wait till next year when we might have better data but have lost the first to market advantage? Should we expand the product line, add another product, or move into new markets? Real options include abandonment options. If things are not going as expected, should we scale back or even suspend the project? Anything that adds flexibility has value. Real options analysis has been a research topic in finance for several years. Years ago, we could articulate the potential for real options, but now we have methods based on the Black-Scholes option pricing model to quantify the value of real options. While basic capital budgeting techniques and methodologies have remained unchanged, the 2017 tax law did provide for so-called bonus depreciation. This provision allows a company to take additional depreciation in the year the asset is acquired, but this is only good for tax years 2018 through 2026. This is clearly designed to encourage investment in depreciable assets. For tax years 2018 to 2022, the bonus is 100% of the cost. The percentage declines for 2023 to 2026 until it reverts to zero in 2027. We'll see how this plays out in real numbers on the next two slides. Example 1. We purchase a $100,000 asset in the 3-year Modified Accelerated Cost Recovery System class. For 2020, we can deduct the entire $100,000 as depreciation, with no depreciation deductions in years 2021 through 23. Example 2. Same $100,000 asset, but now we purchase it in 2023. Our bonus is 80% deductible instead of the 33.3. The bonus reduces the depreciable basis from $100,000 to $20,000. The standard modified accelerated percentages are applied to the reduced basis for each year. This concludes Chapter 11 and Unit F.